Welcome back to the deep dive. Our job is to take your source material, all the research, the screeners, the data, and really turn it into something you can use, some memorable insights.
And today's source stack is a beauty. We're doing a really intense journalistic deep dive into the computer hardware sector.
But we're deliberately ignoring the big names.
Exactly. No Apples, no Microsofts.
Yeah.
We're looking at the engines of volatility. You know, three extremely different players.
So we've got D-Wave, Quantum, SanDisk, and Velo3D. And the mission, well, it's pretty simple. We're going to extract the financial paradoxes, the technical signals, the news that's driving them.
To give you a complete picture.
Yeah.
Enormous risk, and of course the enormous reward that's hiding just below that megacap surface.
It feels like an investigation into three very different versions of the future of computing.
It really is. Quantum, flash storage, advanced manufacturing. Now, because we are digging into performance and some theoretical games, we just had to be crystal clear about this. This is an informational deep dive. We're using the data you gave us for educational and entertainment purposes only. This is not investment advice.
Excellent context. Okay, let's get into it. First up, QBTS D-Wave, Quantum Inc. We're calling this one the Dream.
Good name for it.
So D-Wave, QBTS, it's on the NYSE with a pretty significant market cap of about $9.8 billion. Their focus is quantum computing as a service.
And that right there, that as a service on the quantum frontier, creates just a remarkable financial puzzle.
I've never seen anything quite like it in the data.
That's putting it mildly. What's so fascinating is the tension between their costs and their revenue right now. I mean, they're losing almost $400 million a year.
So their margins are just deep in the red.
Deep in the red. But that's, kind of typical for a deeply speculative tech company.
But here's the paradox. You look at the gross margin, it's sitting at a phenomenally high 82.82%.
And that 82%, that's the key insight. That means their core service, the quantum computing part, is incredibly profitable.
At the point of sale.
At the point of sale. They have a fantastic pricing power. The reason they're losing money overall is because they are just pumping cash into R&D and massive scaling efforts.
Trying to capture a market that barely even exists yet.
Right. It's an investment. It's not a failure of the product itself.
And the market certainly sees it that way. Their price-to-sales ratio is, what is it?
It's an astonishing 405.
405, wow.
I know. That PS ratio means investors are willing to pay over $400 for every single dollar of sales D-Wave makes today.
That is the definition of a speculative dream.
It is. It signals the market thinks current revenue is, well, irrelevant. The only thing that matters is capturing a tiny slice of the future quantum market. It helps, though, that their balance sheet is pretty sound.
Okay.
Debt to equity is very low, 0.06, so they're not droning in debt while they chase this dream.
Let's talk about the news driving this. Looking at the December 2025 data, it's all about establishing a U.S. government business unit and promoting their upcoming Qubits 2026 conference.
Which suggests a very, very concerted effort to land those major defense and government contracts.
The ultimate validation for frontier tech.
Absolutely. And the headlines, they reflect that tension we were talking about. You see one asking, is this the next NVIDIA? And another one saying it's part of the bubble that will burst.
So what do the analysts think?
The analyst sentiment is overwhelmingly bullish. The average recommendation is a perfect 1.00, a strong buy.
A perfect score.
Yeah, we're seeing major firms like Mizuho initiating coverage with targets as high as $46, which is, well above the current price.
What is the current price?
$27.98.
$27.98. Okay, so on to the charts. The long-term performance is, frankly, incredible, up over 500% for the year and over 1,000% in 3 years.
Just a monster trend.
But, and this is where it gets interesting, the momentum has cooled off recently. It's showing slight losses over the last week and month.
So the monster trend is taking a breather. The question for anyone watching is, how do you interpret that pause from a technical standpoint?
Well, the price, $27.98, is comfortably above its short-term 20-day moving average by about 15%, which is good,
Well,
but it's just shy of that critical 50-day SMA. It's about 6% below it. And the momentum gauge, the RSI, it's pretty neutral at about 54.
And when you have that kind of pause, those moving averages, they act like tripwires.
Exactly. So for a technical, let's say, buy trigger, you'd want to see the price decisively break back above that 50-day moving average resistance.
That would be the signal that the long-term trend is resuming.
Right. And conversely, a sell trigger would be a decisive drop below that 20-day SMA. That's the warning that this cooling off period is turning into a deeper correction.
So for you, the learner, watching those two moving averages right now is everything for QBTS.
All right, time for our paper money exercise. If you had the stomach for that kind of volatility and invested, say, $5,000 in QBTS at the start of the year.
Writing that huge year-to-date performance of 233%.
What would that look like today?
Well, to contextualize that massive return, if you'd followed that trend with $5,000, you would have netted a theoretical profit of $11,658.10.
Wow. So that means you're working backwards from today's price of $27.98.
Exactly. The starting price would have been roughly $8.40 per share.
And that initial $5,000 would have bought you about 595 shares.
And what's fascinating to me is that those 595 shares, which created such a huge return, they only represent a minuscule, 0.000017% of the total shares out there.
It really highlights how a small investment can be magnified in these deeply speculative sectors. Okay, let's move on. Our next company, SanDisk Corp, ticker SNDK. This is a very different beast.
Oh, yeah. We're leaving the realm of pure speculation now.
And moving into what we're calling the infrastructure winner. This is a much larger, more established company. It's a $35.41 billion market cap, trades on the NASDAQ, and crucially, it's in the S&P 500.
And their business is the backbone of modern data, NAND flash storage. SanDisk is just a prime example of an existing player getting hit by that massive AI demand shock.
So all the demand for high-speed storage for large language models, training data.
It has completely turbocharged their outlook. Now, technically, they're still unprofitable on a trailing basis. Trailing EPS is negative. But the market is anticipating explosive profitability.
And the forward-looking metrics just scream anticipation. I mean, the forward PE is only 11.13.
And the PEG ratio.
The PEG ratio is incredibly low, 0.12.
Yeah, and that low PEG ratio, it suggests that the anticipated earnings growth is so rapid that the stock might actually be undervalued right now relative to its potential.
So the street sees today's losses as just the cost of doing business to secure that future market share.
Exactly. And unlike the really speculative names, SanDisk has robust liquidity. Their current ratio is a 3.29. They can handle a down cycle, which is a major, major difference.
The news flow seems to confirm all this. The main drivers are that insatiable AI storage demand and the memory niche shortage.
Right, which has led competitors like Samsung to hike NAND prices by 50%.
A huge pricing advantage.
Huge. And then, of course, you have the prestige event of joining the S&P 500 in November 2025, which just solidified their institutional status.
So what are the analysts projecting?
They're clearly on board. The expected EPS growth over the next 5 years is estimated at a stunning 91.77%.
91%.
Yep. The consensus target price is $272.58, but we're seeing some bullish targets pushing all the way up toward $322.
The entire narrative is just capitalizing on the computing gold rush.
It is. And the technical chart reflects that demand shock. The rally has been monumental. Performance year-to-date is 571%.
And over just the last 6 months, it's up 485%.
This isn't speculative noise. This is sustained, broad market participation reacting to a powerful structural shift in demand.
The technical setup is highly bullish. The price, $241.61, is way above all the key moving averages. The 20-day, 50-day, 200-day are all positive. Momentum is just firmly upward.
And what about the RSI?
It's healthy. It's at about 58.
So 58 is strong momentum, but it's not flashing that overbought warning sign yet.
Right. It suggests the path of least resistance is still up. For a decisive buy trigger, the whole setup just suggests momentum should continue. The cautionary sell trigger would be a breakdown below that short-term 20-day moving average.
That would be your first sign of profit taking.
Okay, let's do the math for this one. Paper money, $5,000, based on its half-year performance of 485%.
All right, so if you put $5,000 into SNDK 6 months ago, you would have bought your shares at approximately $41.29 each.
Okay, so that 5,000 gets you 121 shares.
Right.
And carrying those to today's price of 241.61 would give you a final value of just shy of $30,000.
Which is a stunning theoretical profit of
On
$24,235.81.
a $5,000 investment.
I mean, that kind of return just highlights the sheer power of capturing that AI infrastructure boom.
Hmm.
But again, look at the share count. Those 121 shares are still an incredibly tiny fraction, about 0.00082% of SanDisk's outstanding shares.
Even massive profits in a major corporation only require a tiny bit of ownership.
That's the power of the market.
Okay, our final deep dive target. Velo3D, ticker VELO. This is the volatile frontier.
And volatile is the right word. This is a micro-cap company, only about a $280 million market cap.
And their focus is very specific. High-end, metal, laser sintering 3D printing, a key technology for aerospace and defense.
This is a classic example of high risk, high reward. The financial metrics are, well, they're ugly. Gross margin is negative. Operating margin is negative 114%.
So they're actually selling products at a loss right now.
Yes, burning cash to build scale. Plus, their debt to equity is high at 1.08.
So why on earth is the stock up 326% this quarter?
The conviction lies with the people closest to the company. Insider ownership is nearly 60%.
60%, that's a colossal stake.
It is. It signals that management and the founders truly believe the payoff is worth all these current losses.
And the recent news flow is everything here.
It is. VELO had a parabolic jump. It was up over 55% in a single day, tied specifically to announcements about partnerships with SpaceX and Anduril.
Major aerospace and defense players.
Exactly. They are positioning themselves as critical hardware for U.S. defense. You see deals with the U.S. Navy that reinforce that whole narrative.
So this stock is moving on pure, immediate news catalysts. Its performance is completely parabolic, up 111% in a week.
125% over the last month. The price of $13.38 is over 800% above its 52-week low.
This is where the tension gets highest for me, because we see fundamentals, technicals, and analyst expectations just colliding.
Violently.
Despite that spectacular news-driven performance, the average analyst target price is only $6.
$6, significantly less than half the current market price. The analysts are just struggling to justify this valuation jump, even with defense contracts.
And the technicals scream caution. The price is incredibly extended, and the key warning sign is the RSI. It's at an extreme reading of 82.75.
And anything above 70 on the RSI means the stock is highly overbought. The climb has been too steep, too fast. It's extremely vulnerable to a sharp correction.
The price surge has just outrun its own stability.
It has.
Therefore, the implied sell trigger warning is, well, it's imminent because of that extreme status. A buy trigger here is incredibly complicated.
It is. You'd need absolute, unwavering confidence that more defense contracts are coming and that they're powerful enough to offset the technical gravity of an 82 RSI and that low analyst target.
It's a pure gamble on catalysts.
Completely.
Okay, let's run the final paper money math based on VELO's quarterly performance of 326%.
All right, so if you invested $5,000 3 months ago, that massive return means your starting price was roughly $3.14 a share.
So your $5,000 investment would have secured 1,592 shares.
And today, that position would be worth over $21,300.
For a theoretical profit of $16,304.
And notice how different this is. Because it's a microcap, those 1,592 shares represent the largest percentage of ownership of the 3 companies we looked at.
Right.
About 0.0122% of Velo3D's outstanding shares. That's the nature of trading microcaps. The volatility is intense, but the ownership percentage for you as a retail investor is much more achievable.
What an incredible analysis. 3 very different journeys in the hardware world. The high-level commonality is clear. All 3 had massive, multi-100% performance jumps.
But their financial foundations are fundamentally divergent. And that's the key takeaway for you, the learner. SanDisk, the infrastructure winner, is poised for immediate massive earnings. We saw that in its low PEG ratio.
It's riding a known near-term demand shock.
Right. Meanwhile, QBTS and VELO the Dream and the volatile frontier, they're defined by speculation, high current losses, high volatility, driven entirely by this forward-looking idea of massive market capture that could be years away.
And the price-to-sales ratio really tells that story perfectly.
It does. SanDisk's PS is around 4.5, solid, near term. QBTS at over 400 is pure future potential. And VELO at 5.7 is valued solely on those defense contracts that promise to transform its currently negative margins.
And this is where the complexity comes in. You have to balance that powerful, fundamental news like Velo's contracts against the technical reality, like its highly overbought RSI of 82.
And if you ignore that technical warning, you are betting that the story, the narrative, is powerful enough to just push right through the inevitable profit-taking.
That tension is what separates trading from investing in these explosive sectors.
It really is.
So what does this all mean for you? We've seen these incredible returns, but when we look closer at the insider transaction data for these high flyers, a pattern starts to emerge.
Management and directors are often cashing out.
QBTS shows significant net sales. S&K shows a net sale too after its huge rally.
So the people who know the business best are using this explosive price growth driven by, retail enthusiasm and these narratives as an opportunity to reduce their own holdings.
They're realizing their gains.
Right.
Which brings us to the final critical question for you to think about. How should you weigh an explosive stock price, driven by the narrative of being the next NVIDIA, against the fact that those closest to the company are effectively using your enthusiasm as their exit strategy?
That divergence between the price action and insider sentiment,
Yeah.
that's the ultimate puzzle.
And that wraps up this intense sector deep dive. The high-flying, highly speculative, and sometimes highly rewarding world of niche computer hardware. Thank you for providing us with this rich stack of source material.
And we encourage you to continue exploring that divergence between high analyst price targets and highly negative current margins in emerging tech. That gap is where the real story of tomorrow's wealth creation and destruction lives. We'll see you on the next deep dive.